Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. Joining me on the podcast today is Aakash Doshi. Aakash is the global head of gold strategy at State Street Investment Management, which is one of the largest asset managers in the world with over $5 trillion in assets as of the end of June. Aakash, thank you for joining us today.
Thanks for having me, Alex. Pleasure to be here.
Well, gold is a very hot topic, so I'm excited to dive in. But why don't we just start with where and when did your interest in gold originate?
So I was studying energy economics at Columbia University right after the global financial crisis. And there was an opportunity to work in commodities research at a large bulge bracket bank. The global head there was guest lecturing at Columbia University. Apparently, my economic know-how and passion resonated, and he hired me. And I spent about 14 years there in commodities and fixed income research. Most recently as America's head of research. The bank was Citigroup, Global Markets. So really working on the sell side, doing supply-demand modeling, understanding commodities as an asset class. And then really gold was always one of my favorite underlying commodities. I grew up with gold as a cultural norm. My parents are from Mumbai, India. My mom has a lot of gold jewelry that hopefully will be passed on to my sister and my wife. So it's always been a part of my household growing up. And when this opportunity presented itself at State Street Investment Management, I decided to jump on board and learn the ETF business.
That's great. So you talked about gold a little bit differently from some of the other commodities. What are the attributes that make gold a reliable storehold of wealth? And are there any other assets that you think share these characteristics?
I think the history of gold is very unique. It goes back to biblical times. For those who celebrate Easter, for example, it was one of the gifts from the three wise men. There is a lore about gold where it represents wealth and original money, whether we're thinking about medieval times or we're thinking about the fantasy world of Game of Thrones. Gold has been original money for a very long time. And I think as an asset, it has that historical base that very few underliers that are still part of the global financial system and global commodity markets still do. Some will debate gold or wine were the original commodities with the ancient Greeks. From that standpoint, what I think makes gold unique versus other commodities, even though it is a physical asset that you can touch, is what I like to call in a paper I once wrote, the holy trinity of gold as related to inflation, interest rates, and foreign exchange. And what I mean by that is gold can be viewed as a long duration, zero coupon asset like a bond. It can be viewed as an alternative to fiat currency. And it can also be viewed as something that has a store of value that as inflation rises, gold should keep pace or even outpace it. So I think that makes it very unique from a standpoint where it has that history, but it also has this ability in modern financial times to provide portfolio attributes, to provide a unique positioning in a portfolio where as a commodity, it really is global macro 101. And it's linked to that inflation rates, foreign exchange dynamic. And I think that makes it very unique. And it makes it very interesting, to put it mildly, particularly post-pandemic.
And obviously it has no counterparty risk. It's virtually indestructible and has a finite supply. Those are pretty unique characteristics as well.
Yeah, absolutely. As a physical asset, XAU is the ticker on the Bloomberg terminal, but AU is on the periodic table. And yeah, gold can be recycled 100 times and retain its chemical properties. Above ground stock of gold actually over history is constantly rising. That makes it different than other commodities which are consumed, such as oil or even some metals like copper, where there is a scrap market, but over time it can become almost worthless, if you will, whereas gold retains that. So what's interesting is that unlike other commodities, gold can have record prices even when you have record supply. And usually supply catches up to gold demand, which is really driving prices. Whereas when you think of other commodities, Alex, corn, oil, it's usually a supply shock, a supply disruption, a weather event that affects a harvest, a geopolitical event that affects oil supply or sanctions. when you see that supply shock, that's when prices really react. Not saying that the demand doesn't matter for other commodities, of course it does, but for gold, it really is aggregate demand growth that drives prices. And supply can also be at a record, but you can still have record gold prices. And that is something that's unique with gold as a commodity versus others.
The other aspect of it that's unique is we were on the gold standard for a long time. The fiat money was tied to gold, essentially to protect the people who have the money against excess printing. But the US left the gold standard in 1971. Would you tell us what that means and what are the odds that we return to a gold standard?
Yeah, so prior to 1971 and the Nixon shock, quote unquote, in August of that year, fiat currency, and particularly the dollar, there was almost a fixed price to gold. And that system existed and really underpinned under the Bretton Woods system, the post-war global traded economy. Then in 1971, the US delinked from that system. We exited that Bretton Woods system that's quote unquote known as the Nixon shock. And then what you saw is since the early 1970s, the free floating exchange era. And what do I mean by that? That gold and the US dollar were no longer interlinked, but rather the dollar had value because the government said it had value. You had full faith and credit of the US government backing that dollar. So the 1970s was a really unique period for commodities overall, but particularly gold, because essentially you had this fixing of gold suddenly delink and a lot of demand for gold as an asset. You also had a few other factors at that time, 1973 to 75 global recession, the Arab oil embargo, inflation, stagflation. So gold really rose in value, both in nominal and real terms over that period as an inflation hedge, as a stagflation hedge, and as these currencies were recalibrating across the globe. Off the top of my head, I think it was almost a 15x rise we saw from the early 70s to the early 80s in the nominal gold price. In real terms, so in inflation-adjusted terms, Alex, gold hit an all-time record in 1980 that was only eclipsed this year in 2025 in real inflation-adjusted terms.
Is there any chance we ever go back to the gold standard? There's a lot of concern about excess printing of money and debasements.
So I think as monetary supply increases and global fiscal debt loads increase, and notably increases on government balance sheets, there has been a global alternative fiat, global debasement trade, and I think that benefits gold. I think it's tough to put the genie back in the bottle now that we're in a fractional credit reserve lending system. Do I think that gold could be incorporated back in some way into the monetary sector? Yes, through two channels. So one is that central banks and official sector themselves are holding more gold in reserves. And I'm sure we're going to talk about that later on during our conversation. I think the second is there have been proposals that gold could back potentially new issuance of treasuries. Not fully, not the full stack of US debt, but that you could have gold-linked bonds issued by the Treasury. The US government currently holds about 8,400 tons of gold. At current market prices, that's well over $1 trillion. So that could be something to consider down the line as far as sound money or having more faith in fiat currency and the dollar. But broadly speaking, are we going to go back to the pre-1971 era? I think it's very difficult to envisage given how much global sectoral debt is outstanding.
We're going to talk about gold's historical returns. But first, I wanted to ask you, does it make sense to start the clock at 1971 when we exited the gold standard in terms of analyzing the returns and trying to come up with ideas of what we might expect going forward?
Yes, I think so. Even though gold is an old asset that goes back to biblical times, I am always very hesitant when I see memes or LinkedIn posts that look at the gold-silver ratio in 2000 BC. Let's just be relevant about the modern financial era. And particularly 1971 is a good starting point. It's 5.5 decades ago. But that is when we entered this free-floating US dollar era, this post-Bretton Woods system. So I think that makes more sense from a modern standpoint. And really, I think when you were thinking about portfolio allocation, commodities, asset allocation, it's also what have you done recently? So I think post 2000 with the financialization of commodities and the financialization of gold, that's even more relevant. Not that analogs in the 90s, 80s, and 70s are irrelevant, but I think that's even more relevant because markets have become faster, they've become more sophisticated, trading and transaction costs have lessened. So as portfolio allocation becomes more sophisticated, you have to think in more recent terms as opposed to always looking at historical analogs. But we've all heard the saying in financial markets, financial history doesn't always repeat, but it does tend to rhyme. So I think that's important. But my starting point is the 1970s.
Okay. And if we look at the return of gold since, let's say, 1971, it may be surprising to a lot of people because I know a lot of, especially academics, will say gold shouldn't have much of a return. It doesn't produce anything, it has no income, etc. But when you look at the return since 1971, it is surprising. It's actually competitive with equities all the way since 1971. What are some insights you can share about this comparison and what would you expect as a long-term reasonable return for gold?
That's a great point, Alex. And what I would say is the strategic case for owning gold over the last 5.5 decades, not that past performance indicates future returns, is first and foremost potential capital appreciation with low volatility. So since 1971 through 2024, gold has had average nominal returns annually of 7 to 8% and actually closer to 8%. It has a real returns of 3 to 4%. So that means gold is outpacing cash plus inflation as a low volatility asset. And when I say low volatility asset, why is that important? Unlike many other commodities or many other fiat products, such as silver, such as Bitcoin, gold is a low volatility asset. If I look back over the last 40 years, Alex, since the mid 1980s to present, and I look at what volatility has realized for the S&P 500 and gold has realized 1.3 to 1.5 volatility points less than equities. Many other assets realize more volatility than equities. So you're getting this capital appreciation with low volatility. And I think that's really important. That makes gold very unique in a portfolio. I think another point is its diversification benefit. So if you look over this long horizon, gold tends to exhibit lower correlation to US stocks and bonds. And that's particularly important in the post-pandemic era where US stock bond correlations have surged to multi-decade highs. I think a third point that I would keep in mind for gold is there's this concern about global debasement. And I think that's been an accelerated phenomenon post-pandemic. And what do I mean by global debasement? I often ask from a bar trivia standpoint, how much global debt is outstanding worldwide? This is government as well as financial, private sector, corporate credit. And this is not just the US, I'm talking Eurozone, China, et cetera. And that number is 350 trillion. I often get answers of 100 trillion or 150 trillion. No, it's over 300 trillion, close to 350 trillion as of 2025, middle of the year. And that's important because you could say, Aakash, global debt is always rising, just like population growth. What's the big deal over the last 25 years? The government share of that debt has also risen to record levels in 2025. And there were two market periods in the last 25 years that it really rose. One was during the GFC. The second is during the COVID shock. So not only is global debt at record levels, but the government share of that global debt is at a record level currently. And I think that is something that's really driving these debasement fears and this demand for alternatives such as gold.
Well, one of the aspects of gold's return when you study it from a high level that I think is really interesting is so competitive returns to equities over 50 plus years. And what's interesting is the best decades for gold were during the worst decades for equities. And the worst decades for gold were during the best decades for equities. And on average, the correlation is near zero. And competitive returns, lower volatility than equities, diversifying seems like a pretty good asset class if you remove the name and just called it something else.
Yeah, absolutely. Because you'll always have individuals that are anti-gold or say that it doesn't pay a coupon, it doesn't have a yield, but it provides other portfolio attributes. It provides low correlation to equities over a long horizon, as you said. I think in particular, Alex, what's relevant today is that since 2022, as I highlighted earlier, US stock bond correlations are very high. You're not getting that same safe haven left tail hedge from US government bonds and safe haven treasuries as you historically were, particularly at the long end of the curve. You've seen it this year in 2025. You had Fed pricing during volatility shocks like in March and April. Fed pricing become a lot more dovish. Fed's expected to cut, but you've had 30-year paper actually back up. You've seen a lot of bull steepening, what's called on Wall Street, bull steepening of the curve. That's something where gold, I think, really benefits because it's historically been viewed in modern financial times as a long duration, zero coupon asset, but now gold is actually serving as a duration hedge. It's serving as a hedge against some of this devaluation fears, not only of fiat currency, but also the government paper that backs it.
So we can think of gold as an alternate currency relative to fiat money. How should governments think about holding gold as part of their reserves?
That's something that has probably been the biggest driver for gold markets over the last 15, 16 years. It's something that could have legs. So how should official sector think about gold? They should think of it from a reserve diversification standpoint. They should think about it as a de-dollarization and alt fiat asset. They should think of it as a bearer asset that holds no credit risk in physical form and has no liability. And I think the move that you've seen over the last decade and a half, post-GFC, post-global financial crisis, is that central banks have really anchored the gold market. Prior to the GFC, so 2008, 2009 financial crisis, for 40 years, central banks globally were net sellers of gold. Since the Nixon shock in 1971 up until the 08-09 crisis, central banks sold gold 8 out of every 10 years and were hefty sellers of gold. That changed in 2010, and they become structural buyers. And it's important for a couple of reasons. One is they've increased their purchases. So in 2010, they were buying about 10 to 15% of gold mine supply was refined and went to central bank vaults. Since 2022, that number has increased to 25 to 30% of primary mine supply has been refined and gone to central bank vaults. This is critical because these are price inelastic buyers. These governments and central banks, they're buying for geoeconomic, geostrategic concerns and for long time horizons. They're not looking for portfolio alpha in year one or over the next 18 months. They're thinking about 5, 10, 15 years. So I think in 2026 will represent the 17th year of consecutive central bank buying, dare I say. I think 5, 10, 15 years, there's still a tail for this, just like we saw pre-GFC. And if I'm wrong 15 years from now, I'm sure this podcast probably won't be remembered, not to denigrate our great conversation we're having right now.
We touched on this a little bit. There is something a little bit different about gold relative to the other commodities in terms of its investment attributes. So when you have an economic downturn, oftentimes you see the other commodities go down quite a bit, whereas gold may rally. Would you talk about that?
Yeah, that speaks to gold's unique nature as a physical commodity with aggregate demand that's both pro-cyclical and counter-cyclical. What do I mean by that? Commodities is an asset class, and every major commodity index will have gold exposure in varying amounts because gold is a very liquid, globally traded, high-value commodity. But they're going to have a lot of oil in there. They're going to have copper, silver, etc. What tends to be the case with commodity demand generally is it's pro-cyclical. If growth is going up, commodity demand will go up. As population and GDP per capita are rising, you're going to have more consumption of certain commodities, and that can be driven by policy shifts and industrial production and activity. Gold takes some part in that. When you have something like about 10% of fabrication demand of gold goes into AI chips and industrial uses, dentistry, etc. But you also have counter-cyclical demand. Some of that can be investment demand, where gold is your left tail hedge as opposed to your right tail event. I think another part that's been really important, and I highlighted again, is that central bank and official sector demand. That's not necessarily pro-cyclical or counter-cyclical. That's almost geostrategic, price inelastic demand. So that sets a support for gold. So I think because gold has jewelry, which is pro-cyclical, investment demand, which can be counter-cyclical, central bank demand, which is neither pro-cyclical or counter-cyclical, it makes it a very unique commodity on the aggregate demand side of that curve. Whereas historically, if you think about oil, you think about copper, you think about silver, you think about corn, these tend to be pro-cyclical commodities. And that's why commodities as an asset class is more pro-cyclical. Gold is unique in that way because of its varied source of demand.
Well, we live in very interesting times. Are there any historical analogs to today's market backdrop that you feel offer insight into the current gold dynamics that we're seeing?
Well, we are in uncharted and unprecedented times for gold. We did hit multiple records this year, first 3,000, then above 4,000. The title of my October monthly gold monitor report, which is available on ssga.com, that's the State Street Investment Management website, was titled Echoes of the 1970s and the Potential Path Above 4,000. I would say that we are not in a stagflationary environment, but the risk is higher today, certainly than it was 12 months ago or 9 months ago. And what do I mean by that? Very simply, inflation is staying stickier at higher levels. We're not at Fed's 2% target. Maybe 3% is the new norm, or 2.5% to 3%.
We haven't been there in like 4 years.
Correct. Second, the labor market is weakening. Now we have a U.S. government shutdown, so the data are a little bit more opaque. But if you look prior to that, you were seeing job gains of about 50,000 a month versus the previous trend of 150 to 200,000 jobs per month in the non-farm payrolls. Unemployment rate has ticked slightly higher. So again, the risks of a slower growth, weaker labor market, and somewhat stickier inflation, they're there. Now, they're countervailing forces. AI could really drive productivity gains next year. I've read some estimates that the first 6 months of this year, AI and technology investment counted for about 90% of aggregate demand on the GDP side of the ledger. That's incredible amounts of money that's supporting the economy, supporting the stock market, but it also has a crowding out effect. It probably keeps rates a little bit higher because of that demand of capital. So it's all interconnected in my view. What if some of those gains don't play out next year? At the S&P 500 at 6,850, 6,900 at the time of our discussion, Alex, what if there's a drawdown event next year or a volatility shock, something we haven't seen since March, April of this year? What's unique in this environment is I think gold and equities are near record levels. Why hasn't gold corrected? I think it's some of these structural factors we talk about, the debasement, the dollar. Now the Fed is cutting again. That helps gold, in my view, over the medium term. So I do think you're seeing a unique period for gold in this environment. And any correction will likely be bought into, in my view. And there's still a lot of healthy demand on the sidelines.
So let me ask you a bigger question. What are your thoughts on the US dollar as the world's reserve currency, especially given the growing deficits and the enormous and growing debt?
I think the US dollar is still here to stay. I think the fiat system is here to stay. You asked me earlier, do I think we'll return to gold standard? I don't. If you asked me to bet, I would bet most of my money that we don't return to a gold standard. However, you have to keep in mind the size of these markets, and you also have to keep in mind the alternatives and what that means. And let me explain this. So the global sectoral debt is $350 trillion. Global equity markets, give or take, off the top of my head, $150 trillion. Global gold, that's a $25 to $35 trillion market. So incremental flow into gold can have a more outsized impact on price vis-a-vis equities and certainly bonds, given the outstanding debt there. Now, dollar terms of trade are still done in dollar terms. Most commodities are still traded in dollar. It is the official reserve currency. But what's interesting is that gold is up against all emerging market and G10 developed market currencies this year, but it's really outperforming in dollar terms. And I don't think that can be ignored. I think the biggest driver of gold, at least in 2025, not necessarily 24, but 25, has been dollar devaluation. The first 7-8 months of this year was largest dollar sell-off and deval that we saw since the 1970s. So it's no surprise gold, largely priced and traded in dollars, has had its best year since 1979. What I think is interesting is what's happening going forward. Now you have the Fed cutting again. You have a U.S. administration, Treasury Secretary Bessent and Trump, that don't want a strong dollar. They're not fighting a weaker dollar. So maybe that increases the modal probability of dollar devaluation in the medium term. And I think the third point is Liberation Day policies. I think that can have a lasting impact on foreign demand for U.S. treasuries, foreign demand for U.S. dollar recycling into U.S. dollar assets. And I think gold incrementally benefits from that. So a lot of confluencing global macro forces, policy forces, Fed, et cetera, all working in tandem, I think, to help rebase that gold market higher this year. And I think the future of the dollar is really critical. If the dollar continues to devalue, gold should benefit in 2026.
It seems we may have also hit a crucial inflection point a few years ago when the U.S. weaponized the dollar during the Russia-Ukraine war. How do you think about that?
Absolutely. In 2022, you saw central banks globally buy over 1,000 tons of gold for the first time in the free-floating post-Nixon shock era. So the first time at least since the 1960s. And they bought 1,000 tons per annum minimum, not only in 2022, but also in 2023 and 2024. In 2025, I'm modeling somewhat around 900 tons of purchases this year, give or take. So down a little bit more than 10% year on year, but still historically very elevated levels. That's 4 years in a row that if you look on a rolling 4-year basis would be by far, we're talking double any other rolling 4-year period in the free-floating US dollar era. I think the weaponization of the dollar has played a part. And it really started, again, not just in 2022, but prior to that. In 2014, with the Russian annexation of Crimea, you started to see central bank demand rise. Then 4 years later, in 2018, with the U.S.-Sino trade war, you saw central bank demand rise. Then 4 years later, in 2022, Russian incursion into Ukraine, you saw central bank demand rise. I hate to be one of patterns, although my toddler son loves that. He's 5 years old and he loves patterns. But 2026 would be 4 years later after 2022. We'll see if another phenomenon comes in to help structurally lift the central bank demand trend. But what I would say is it's very critical. It's very important. And I do think what U.S. policy has been with weaponizing the dollar to some degree does incentivize emerging market central banks, or the ones buying the gold, to reallocate their reserves to some degree. And it accelerates maybe the de-dollarization trend to some degree for some reserve managers.
The other factor to consider is, for the first time in recent memory, private investors are buying gold in size. What are your thoughts on their role in the recent rally we've seen?
Very important, very critical. A lot of us in financial markets, Alex, we think about gold ETFs or gold futures. Bar and coin investment, physical investment in gold is actually very critical to understand the pricing mechanism of gold and to understand where the demand for gold is coming from. And what's unique about 2025 is that you're seeing very strong ETF inflows, record in dollar terms, the strongest tonnage that we've seen since 2020. But bar and coin demand has still been pretty decent despite these record high prices. And I would say certain regions like China, you've actually seen stronger physical gold demand from private investors and consumers than anyone would have expected 3-6 months ago. To interlink all the points, I think some of that is post-Liberation Day driven, but I think some of it is just idiosyncratic support for gold. China consumers buying because of CNY or local currency devaluation fears. I think some of it because the property market never recovered to pre-pandemic trend. Some of it due to the fact that China has capital controls and gold is one of the few fungible global assets that Chinese investors have access to there. So I do think this notion of gold gaining popularity and accelerating in Asia over the last couple of years has been a key driver. And then Western private investors as well as ETF investors coming back into the fold, I think that's been the big driver this year. If we have a chance to later on in this conversation, I can definitely talk about what I think are the cyclical drivers of gold post-pandemic and why I think 5,000 is more likely than 3,000 next year.
Let's do that. Let's hear your thoughts on that.
Yeah, sure. So if I take a bird's eye view, I think the gold market has rebased higher in that what I previously said earlier this year, that 3,000 was the new 2,000. I think 3,500, 3,600 is the new 3,000. So I think that's a good support area for gold. And I can talk about where I get that number if you want in more detail, but I want to get that point across. Gold in particular is still underallocated. In October, some would argue it might have been overbought. That's different from being overallocated. So let me explain very quickly of how I think about this gold price cycle. Again, echoes of 1970s, but let's even take stagflation and all of that aside. What do I think has driven the gold market very broadly since the pandemic, when we first hit $2,000 an ounce and then have traded since? So I look at the 2021, 2022 inflation scare and the Fed hiking cycle and the Russia incursion into Ukraine. I look at that as an inflection point that helps solidify 2000 as a price floor. And I think that was mostly driven by physical demand because that central bank demand for gold increased dramatically, as you pointed out, Alex, or you asked in your question earlier. When Russia invaded Ukraine, you saw central banks increase their purchases above 1,000 tons for the first time on record, and they maintained those levels for several years. 23, 24 as well. This year, like I said, will be strong. So it's the first part of the gold rally or the gold support rebasing higher was this physical demand from central banks, and then also from China consumers and China retail. One little tidbit, China consumers and retail demand, not the PBOC, not the central bank, although some of this could be shadow imports from the PBOC, but China consumer demand, if you back out that data and decompose it, has been higher than all central banks globally for gold every year for the last 3 years. Let me repeat that. China consumers are buying more gold than all central banks globally every year since 2022. It's remarkable. I think those two factors is the first leg of the price support, physical demand. 2025, starting in mid-24, but really 2025 solidifying it, it's the return of the ETF investor and the Western ETF investor. Number one driver of prices this year, ETF inflows, in my view and in my model. What I think can take us to 5,000 next year is the allocation to gold away from unmanaged duration, away from money market mutual funds that have over $7 trillion in US dollar assets as we speak right now, Alex. And I think that's the next leg for gold to get to 5,000. So very simply put, to give hard numbers as opposed to throwing a number in the air, how do you get to 5,000, Aakash? What's required? Central bank demand staying within plus minus 3% of this year's level, APAC demand being flat, and ETF inflows in 2026 globally at 75% of the pace of 2025. I think that's sufficient to get you to 5,000 an ounce next year.
You talked about allocation, and I think that is important because if it becomes more broadly accepted that gold deserves a more strategic allocation within portfolios, if you scan across institutional and high net worth portfolios today, is your sense that they're heavily underallocated relative to what is a more reasonable allocation given the backdrop you described?
Yes. And I think that's true across all verticals. So 2024, gold was the number one performing global macro dollar denominated asset. In 2024, gold outperformed the S&P 500 outright and in risk adjusted terms. Off the top of my head, 27.2% was the simple return in 2024. And real returns were also well above 20%. Now, we saw globally in 2024 ETF outflows, mostly driven by the first half of 24. In the second half, we saw inflows, but once you had the US elections, there was actually a lot of selling in November and December last year. It's really only been in the last 6-8 months that you've seen allocations start to increase in size and with some duration and scope. So most clients that I've spoken to, but you could also normalize this and survey work that we've looked at, et cetera, most investors missed 2023 and 2024 and even a lot of 2025. It's only in the last few months that I think you've really started to see allocations being added. I would note even in January of this year, we saw ETF outflows in the Spider Suite. Then they've come roaring back really since March, April. So I do think March, April was a little bit of an inflection point, and that reallocation is going to increase over the next couple of years. Again, not necessarily from equities, but from unmanaged duration exposure, so long bonds in particular, and perhaps, like I think, for money market mutual funds.
We know that investors oftentimes chase returns. So when you see something go up 40%, 50%, et cetera, it's going to draw eyes towards it. I like to focus on where is the long-term allocation for portfolios. If it's relatively low, that's a very different starting point than if it's relatively high.
Yeah, at State Street Investment Management, we consider gold a strategic core asset in a portfolio. We have a white paper that's available on ssga.com. Any listener that wants a copy, just see the website, look up my name, and it should be available there, ssga.com. Our paper does go up to 10 to 12%. And let me frame it, why that works as an allocation. You manage a lot of money. You're a very prominent advisor across the nation, if I do say so myself. And we're connected on LinkedIn. And I've looked at a lot of the talks that you've given recently. And I think what's interesting, and this won't be controversial, is that post-pandemic, but you could even argue over the last 10 years, 60-40, 70-30 is not a 2025 allocation mix, especially as the point I mentioned earlier. Since 2022, U.S. stock bond correlations are very high. So what should be that allocation? Should it be 55, 25, 20? Should it be 50, 25, 25? What is that last number I'm alluding to? 20, 25%, maybe even higher, maybe slightly lower. That's your alternative sleeve. And in my view, and in the work we've done, a lot of the clients I've spoken with on the RIA side, on the broker-dealer wealth management side, is that gold deserves its own liquid alternative sleeve in that broader 2025 bucket, which then includes commodities, which can include private assets, which can include real estates and other exposure. But gold is unique from a portfolio standpoint because of all of those assets that I'm mentioning, it is the lowest volatility asset. And to the extent bonds have this issue of too much supply in the market, this inflation impulse, this fiscal impulse, we haven't even talked about that in the US, you might have an issue where 10s, 20s, 30s, they're unable to rally sufficiently without a huge recessionary shock, where gold then serves as your portfolio counterweight. It serves as your safe haven left tail hedge in that environment. So again, 3 to 12% with the sweet spot around 5 to 7 on an average portfolio is where we recommend a gold holding to improve your volatility adjusted returns over the long run.
And is it fair to say that most portfolios, at least in your experience, have far less than that in gold?
Yes, because many portfolios have 0%. You have many people that don't like gold because it doesn't provide a coupon or yield, or that it's difficult to value because you can't do a DCF or discounted cash flow model. You can't look at a forward PE ratio of gold. But my argument would be that it provides other portfolio attributes. Capital appreciation over the long run, very low volatility, very low correlation. And in this environment, post-pandemic, we've mentioned it so many times with the debt, alt fiat, et cetera, it's a global debasement asset.
I often find it helpful to try to listen to the market, take a step back. And when you look at the top 5 calendar year returns for gold since 1971, they all occurred in the 1970s. And you alluded to this earlier, but 2025 would crack into the top 5 if it ended today. So what is the market telling us about the current environment?
The market is telling you that A, gold was probably undervalued pre-pandemic and post-GFC. 2, that it is concerned about just the level of debt and the fiscal impulse and inflation impulse in many developed market economies. Keep in mind, gold is up to record terms in dollar terms this year, but it has also hit records in every other emerging market and G10 currency this year as well. So from that statement, I do think it speaks to a global phenomenon as well. Now, does that mean that it goes on a straight line up? Of course not. Nor should it. If anything, a consolidation would be healthier from a price cycle standpoint. It allows for broader participation because many people will have a FOMO about gold, fear of missing out, which you often see in tech stocks, less so in commodities and precious metals. But I think that's what you saw over the last month and a half. You saw record inflows into gold ETFs in the month of September, all-time record in dollar notional terms, very strong tonnage terms as well. And I think that last $300, $400 move higher, when we went from 3,700 to 4,000 and then very quickly above 4,300, I felt like that was a lot of new money, fast money, leverage getting into the system. And that last in is the first out right now. And if we stabilize here in the mid-high 3,000s, I think that's actually more promising for 2026 returns than if we had what's known in commodity markets, a blowout top, where you really spike higher, but then you crash afterwards. And I think from that standpoint, a lot of these structural factors driving gold, they're still in play for 2026. And they're just different factors driving it than equities. So you've had a sharp rally in both over the last 6 months. And I think there's arguments to be made that having gold as your safe haven hedge in that environment is even more attractive, because what happens when there is a volatility shock or a liquidity event or an S&P correction, which we haven't seen since April of 2025? Gold might benefit as your safe haven hedge there.
It is interesting because many of the factors that you just described, excessive debt, sticky inflation, even the under allocation to gold, those have existed for a long time. It just seems like all of a sudden the market has realized, this is actually an interesting asset class, and it all hit at once. And then you had the FOMO play as well. It is pretty fascinating how it all came together all at once.
Absolutely. Again, it's going to be a debate in the market, especially now that we're come off from the all-time highs, but it's still a very strong year. But I think there's a fair case where the market revalues higher. Remember, prior to the global financial crisis, 1,000 was a price ceiling for gold. Then it became a price floor. Then 10 years later, the pandemic hit, COVID shock in 2020. 2,000 became a soft price floor. It wasn't a hard price floor, but really 1,800 to 2,000. That's where prices averaged over the next couple of years up until the end of 2022. And then in 2023, you started to make the move higher, and 2000 really solidified itself. You broke into the mid 2000s in 2024, and then 3000 was hit in the first quarter of this year, so third month of this year. That became a reset higher for these various reasons that we talked about. I think the move to 4,000 came a little bit quicker than anticipated, but I think it speaks to the concerns in the market about inflation risk, about a weakening labor market. Are we going to get the returns from AI that are being priced into the market? One interesting point on equities, again, I'm not pulling out of equities into gold necessarily as much as I would be from fixed income or cash, but the CAPE ratio is among the highest in history right now. What do I mean by that? That's a forward outlook of the PE ratio on the S&P 500 versus its trailing 10-year average. And that right now is, I think, the second highest on record. The previous time it was this high was into the dot-com bubble crash. Again, I'm not saying that we're at the same analog, but it's difficult to argue that gold doesn't play a left tail portfolio hedge in an environment where a lot of things have to go right for equities to continue the same momentum. Whereas I feel like gold is moving on some of these more structural issues of debasement, dollar, now the Fed cutting again, and so forth.
You touched on this a little bit, but one of the pushbacks that I hear is you can't tell if gold is overvalued or undervalued. Are there any metrics that you look at to get some idea of maybe where it stands historically?
One thing is you can look at ratios of different assets, so nominal to nominal or real to real. One example is the S&P 500 in gold terms. So that's looking at, in the simple terms, at the S&P 500 a gold ratio. That has been below its pre-pandemic, pre-2020 mean for the last 6-7 months, since March of this year. So even as equities have had a V shape, gold has held its own and also rallied over the last 6 months. Historically, when you've had an S&P 500 in gold terms at this level, it signals recession risks or at least slowdown risks. You saw that in some of the hard data. I think the other way you value it is looking at gold as a physical commodity, as a physical asset. So having a supply-demand model. And if gold demand growth is outpacing supply growth, which it is in 2025, which I expect it to do in 2026, then you need a higher equilibrium clearing price. That's kind of a commodities 101, econ 101 standpoint. And I can get into those dynamics. I think a third is understanding gold's pricing mechanism. It's not co-determined with other assets, but it's a one-way transmission mechanism. Okay, that sounds like a lot of jarbled Columbia University econ talk. Let me distill it. Oil and interest rates, or oil and FX, have a two-way flow. Oil is a big part of current accounts and commodities terms of trade and trade balances at a lot of economies. So oil can help determine emerging market FX and then vice versa. There's a transmission mechanism. Oil drives break-evens and inflation expectations. Gold is different in the sense that the transmission mechanism is one way. The bond market can affect gold, but typically the gold market doesn't affect bond valuations. And the same is true on inflation. Gold doesn't drive inflation, but inflation can drive gold prices. So I think understanding that transmission mechanism makes sense a lot as well. So you put it together in some sort of model where you consider real rates, inflation, physical S&D, and you come up with a fair value. But I think the most important thing is if demand growth is greater than supply growth, commodities 101 says the price has to go up.
And how should investors think about the differences between investing in physical bullion, gold ETFs, or mining stocks?
I'll start with mining stocks first. That can be a tactical trade, just like silver, but that is not providing you the portfolio attributes and that strategic role that gold does. Mining stocks, more volatile than the S&P 500, high beta in your world. Gold, less volatile, low beta. Gold mining stocks, you have to deal with free cash flow and dividend yields and company management. Also, where in the gold mining sector do you invest? Royalty players, streamers, the big conglomerate miners. Gold mining is very fractured around the world as well. It's mined in 6 continents out of 7 and $4,000 an ounce. I'm sure Antarctica will be in place soon enough. So it's very fragmented. It's difficult to think about what is the right play, although tactically it can be a great trade as it has been in 2025. Gold, from that standpoint, has a role in a portfolio that's providing capital appreciation, low volatility, diversification, and so forth. It's providing you that unique left tail, low volatility hedge. So that's how I think of it differently. What was the other asset to compare it to, you said?
Just the physical bullion.
So this is getting into a product discussion. So I consider gold mining stocks just different from the underlying gold. Yes, they're correlated, just like ExxonMobil can be with oil prices or Archer Daniel Midland can be with corn prices, but they're different. No one would say oil is ExxonMobil and vice versa. I don't consider the gold mining stocks the same as gold in a portfolio. Now, how you access that gold is an interesting question. You can access it through derivatives and futures, ETFs, or physical. Some argue that having physical gold is the right way to do it. And if it's some physical gold, sure. Listeners can't see, my watch has gold in it, my ring does. And you could even have some gold in your house safe or your safety deposit box, sure. But when you're thinking about real allocation, you can't keep gold under your mattress. And the cost of transacting in a physical bullion market is very expensive. Look at the largest gold vault private banks. Your premier customer, you still might be paying 2.5%, 3% just to buy the gold, premium, a markup to transact. In some cases, 5, 10, even 15% markups to have that physical gold. Then of course, if it's any sizable amount that has a real value, you can't keep it under the mattress or at grandma's house. You have to pay for vault storage and insurance. That's all a cost. And then if you need that liquidity on the other side of the market, you're going to have to pay a discount. The ETFs, and this is true for all gold ETFs, if I'm honest, that are physically backed or 33 Act products, but the SPDR tickers, GLD and GLDM, are the market leaders, by far the largest gold ETFs in the world, largest commodity ETFs and funds in the world. They have the advantage of transparency. They have the advantage of very low transaction costs. Physical gold, you could pay 2.5%, 3%, 4%, 10% markup as a retail investor or even a high net worth investor. Trading GLD can cost less than a basis point to move $10 million, to move $100 million. And from that standpoint, it's still physically backed, but you have this liquidity, you have this transparency, and you have this very high correlation to the spot gold price, so meaning very low tracking error. There's very little slippage with the gold ETFs. It's a very efficient way, I like to say, of transacting in the market. Futures is another way you can access gold. That's a good way to get leverage in gold. I would say the issue with that, and this is getting a little technical, and especially since this is not a video podcast, but an audio, you have something called a roll yield in commodities. To have that exposure, you have to constantly roll contracts. And if the commodity curve is upward sloping, you have to buy high and sell low to constantly maintain that short front end exposure. Also, gold futures have become less liquid since the pandemic, while gold ETF liquidity has increased since the pandemic. So to me, at State Street Investment Management, maybe I'm a little biased, but I do think from an honest perspective, the ETFs are a transparent, easy way to access gold. You can get physical spot price exposure that way to the commodity. That is not possible with any other commodity. You cannot get oil spot exposure. You cannot get copper spot exposure as an investor. I think many people don't realize that. Precious metals, and particularly gold, is one of the few ways you can get spot exposure to a commodity. And the only way you can get that spot exposure is actually through the ETF or owning the physical. But that physical has a lot of frictions if you're doing it on your own.
Many argue that gold has a new viable competitor in Bitcoin. How do you compare gold and Bitcoin as investment assets?
I look at gold as a left tail hedge and Bitcoin as your right tail hedge. Prior to joining State Street Investment Management, it's only been 11 months here, but I spent, as we said at the beginning of our conversation, about 14 years at a bulge bracket Wall Street bank at Citigroup. I was a founding member of a cryptocurrency research working group there in 2018. And we looked at Bitcoin as a foreign exchange, as a commodity, as a tech stock. What do you think it was most like?
It probably acted mostly like a tech stock.
Yeah. It acted mostly like a tech stock because it had that similar volatility profile. It had inflow, outflow that very much correlated with tech stocks. It had an adoption growth curve, which was very much based on future growth prospects and not a long history or track record. So very similar to that. And I would say as recently as even 4 years ago, 5 years ago, Bitcoin bulls and gold bugs, they would have friction. They would butt heads. I think now, especially with gold's performance over the last couple of years and this global alt-fiat debasement trade, it almost coexists. I think gold is your left tail, Bitcoin's your right tail. Gold is there as your safe haven, low volatility asset. It lowers portfolio volatility. During liquidity or volatility shocks, it is your liquidity or volatility hedge. It also has that pro-cyclical and counter-cyclical sources of demand. And in the case of central banks, non-cyclical source of demand. Bitcoin, for all its press and the advent of the ETFs, particularly, have certainly helped mainstream adoption of Bitcoin. It is still driven by investment demand. That is the source of Bitcoin demand. It's not used for anything else. So as a store of value. So I think there's overlap in the investor base, but Bitcoin is a high volatility asset. What I like to do is not to try to convert people who are Bitcoin bull or crypto native into gold, is understanding how both can coexist. And in fact, that is a title of a paper that's on State Street's website, how gold and Bitcoin can coexist in a portfolio. And what we found is that Bitcoin can help juice returns. Its price performance can be very volatile, but can be trending upwards, while adding gold to the portfolio with Bitcoin actually improves returns overall, lowers volatility, lowers drawdown risk. I think having both actually makes sense if you're someone who believes in having crypto exposure. We backtested this by looking at 60-40 portfolios, 70-30 portfolios, and then adding a Bitcoin sleeve alone, and then adding a Bitcoin and gold sleeve. And what we found is that having that gold sleeve makes a lot of sense. So I think the way to consider it is, especially if you talk to young advisors or people who just really believe in new technology or just love crypto, there's no need to convert them away from that. It's explaining to them, hey, gold has a role here in this portfolio too. If you want a thin sleeve of crypto or even a large sleeve of crypto as part of your alts bucket, gold can be there too to help mollify a lot of risks from a high volatility asset. And Bitcoin is still a high volatility asset despite it becoming more adopted across institutions.
You shared some thoughts about a strategic allocation to gold in portfolios. Do you feel like today's environment, which is relatively unique, warrants perhaps a higher strategic allocation to gold?
So Ray Dalio at Bridgewater has said, again, a 15% allocation to gold, and State Street Investment Management works with them. They sub-advise our all-weather risk parity fund. I personally think that, yes, there is a need to have some sort of hedge to this global fiscal debt story, because that's the one thing that's not being resolved in the current convoluted geopolitical, fiscal, global policy landscape. If there's one thing that hasn't changed this year, is that the fiscal trajectory for governments and global debt loads, they're not expected to get paid down. And in fact, there's probably no escape velocity over the long run. So from that standpoint, I look at what impact in my portfolio, what plays out if you have this ongoing bull steepening bias in the treasury curve, that 10-year paper, but really 30-year paper only has so much that it can rally. You have this fiscal and inflation impulse. What are some alternatives that could work in that environment? And I think gold is one of them. I think you take it in and you dip your toes in, especially when prices are this high. If I had said, yeah, sure, let's invest 40% in gold, 50%, maybe you don't want to listen to this podcast, you run out the door. If you're a more conservative investor and you're concerned about inflation risk and having this duration exposure, particularly from bonds, where you think money market yields are going to yield negative real returns next year, which is possible if the Fed keeps cutting, and you're in a high tax state like California or New York, where I live, then you might have 0% or negative returns in real terms for money markets. So maybe I allocate a little bit of my cash to gold because I'm getting these other portfolio diversification benefits and potential capital appreciation in the long run. So for me, yeah, I think the time to allocate something to gold is still there strategically right now. Do I love it as much as I did in January of this year? No. It was the second paper I wrote this year for State Street was, is it too late to invest in gold? No, exclamation point. Of course, back then, gold prices were $2,600 an ounce. At $4,000 an ounce, is it too late? Maybe there's no exclamation point, and maybe you just dip your toes in. So that's kind of where I stand on it.
Well, Aakash, I appreciate you taking the time, sharing your insights, your experience, and also all of the perspectives. It's been insightful to me, and I hope our listeners as well. Thank you.
Thank you for having me. It's been my pleasure.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.